Welcome to this Killik Explains finance video. This week, earnings manipulation. 3 warning signs. When you get to earnings season in particular, watch out. So, earnings beats are everything to everyone. What do I mean by that? You'll hear analysts and in the industry jargon, people talking about beats. And that is when basically a company manages to exceed the earnings forecast, the consensus earnings forecast that analysts working for the research houses and so on have put on the firm. And that is good news for everybody because it'll tend to boost the share price, boost the reputation of the CEO and keep everybody happy. So let's take a look at that. Bottle stuffing is a classic example of when things can start to go wrong. So the temptation to create an earnings beat can spill over into slightly dubious practice. Now, here's a massive example. Coca-Cola was accused of engaging in this practice between 1997 and 1999. Basically, to cut to the technical chase as it were, it involved persuading Japanese bottlers to order more of the concentrate, the sort of magic ingredient behind the product, via relaxing credit terms with those bottlers. The result, orders could be booked as sales, profit was boosted, and then the SEC walked in and said, actually, this worked in the sense that it contributed 2 cents to Coca-Cola's quarterly earnings per share. You might think 2 cents isn't much, but that was enough basically to make the difference between the firm hitting and missing analyst estimates in 8 out of 12 quarters. All right? So there is the temptation basically. Now, moving away from Coca-Cola for a moment, in a nutshell, a reputation for consistently beating analyst forecasts is an important motivation for executives to engage in earnings manipulation. So, stating common sense in a way, but we need to take a look at this and draw some conclusions as an investor. That's an important recent study from 4 research analysts, if you like. So, the incentive is what? What moves share prices up in the first place? Just remember this, analysts produce consensus earning forecasts. So analysts paint a picture of what they think a company can do. CEOs want to make sure they beat that so that the share price gets an additional boost, if you like. And that is good news because rising share prices affect the image of the CEO in question, boost the value of remuneration that's linked to the share price, keep the investing community happy. Everyone's a winner. So, the spiral then, as I call it. Executives get a reputation for beating earnings estimates. Their careers are built on it, if you like. Pressure then builds to maintain what's called the value premium. This can be done within the rules for a while, so they might look at ways, cleverly, of tucking profits away, releasing them in the right years to boost earnings, beat those forecasts. But eventually, they run out of gas, if you like. They run out of balance sheet manoeuvres, room for manoeuvre, and then comes the temptation to actually bend the rules to keep those earnings beats going. Now, the 3 horsemen of the manipulation apocalypse, as I rather grandly called it, if you like, are what, therefore? The 3 external factors that really put the pressure on. Shares rated a buy or a strong buy already. Clearly, that's number 1. There's not much wiggle room once you're already a strong buy. Firms where institutional holdings are rising. So the effect of that is money is moving in, chasing this superb performance, if you like, and stocks that are already expensive with high PE ratios. Not saying every single time this is going to crash and burn, guaranteed earnings manipulation, but certainly likely to be the case, much more likely than firms without those 3 factors in play, if you like. And no one's saying no. So basically, CEOs drive this problem when they're powerful and dominant, non-executives are weak, and they have a track record of using aggressive accounting. So what do you take away from all of this as an investor? And the answer is, don't be complacent. Don't just sit running winners without asking some fundamental questions. All right? First of all, is this a company run by a dominant CEO? Secondly, is it consistently, almost too consistently, beating earnings estimates? At which point you need to start drilling into how. And is it already expensive? All right? And if you get wind of 1, 2, and 3 together, is it the kind of firm you want to remain invested in? Food for thought there. Any questions? editor@killik.com. And if you want to see videos on things like PE ratios and how to judge powerful CEOs and so on, please go to our library, killik.com/learn.